Lucas and Michelle are sitting at a kitchen table at 11 p.m. on a Tuesday. There's a pre-approval letter for $480,000 on top of a stack of unopened mail. Michelle's coffee has gone cold. Lucas's loan officer sent an email with 3 different phone numbers in the signature because apparently one wasn't enough. Their parents have already texted the word congratulations with 2 house emojis, and somewhere deep in both of their guts, something is telling them this doesn't feel like winning. It feels like signing a waiver. So Michelle does the thing nobody in the transaction wants her to do. She opens a calculator, and within 11 minutes, she realizes that the smiling people sending them DocuSigns are not, in fact, on their team. They're on the team of the closing. My name is Nick, and today we're walking through the most expensive cultural assumption in America. The one that says buying a house in 2026 is a smart financial move. Because when you actually do the math, you don't find an investment. You find a very beautifully decorated trap. Let's start with where we actually are. The median existing home in America now costs $408,800. That's the 33rd straight month of year-over-year price increases, which at this point is less a trend and more of a personality disorder. The 30-year fixed mortgage rate is hovering around 6.3%. And according to the Atlanta Fed, owning that median home consumes 47.7% of the median household's income, nearly half. Not 28%, which was supposed to be the threshold for sustainable. 47.7. For 2 years running, we've been hovering in what economists politely call the punishing range. The rest of us just call it Tuesday. The price to income ratio in America is now about 5.0. Historically, from 1975 through the late 1990s, it sat around 3.0. We are now worse than the 2006 peak. 78 of the 100 largest metros are at all-time record ratios. I'll say that again because it deserves a second pass. We are at the worst home price to income ratio in modern American history. And somehow the collective advice is still, you should get in before you get priced out. Priced out of what? The emergency room? Let me put 5.0 into human terms for a second. If you're making the median American income of around $80,000 a year, the median house in this country costs you 5 full years of your entire pre-tax salary. Not 5 years of savings, 5 years of everything. Every paycheck, every bonus, every tax refund, rent money, grocery money, the money you spend on the birthday card you forgot to mail. All of it piled into one house. And we haven't even talked about interest yet. Okay, so back to Lucas and Michelle. They find a $400,000 house because that's what $480,000 of pre-approval actually buys you once you leave room for taxes and insurance. They somehow have $80,000 sitting in a savings account, which already puts them in roughly the top 5% of Americans in terms of liquid cash. But sure, let's call them average. They put 20% down. They finance $320,000 at 6.3% for 30 years. Their monthly principal and interest comes out to about $1,980. Add property taxes at around $367 a month. Tack on homeowner's insurance at $167. Toss on an average HOA of around $272 because somebody has to pay to keep the retention pond free of geese. That's $2,785 a month right before a single thing in the house breaks. Here's the part the loan officer skipped over in his 6-page PDF. In the first month of that mortgage, out of the $1,980 they send to the bank, $1,680 of it is pure interest. Only $299 is actually paying down the loan. That's 85% of their first payment evaporating into someone else's quarterly earnings call. And it stays this lopsided for years at 6.3% on a 30-year fixed principal, doesn't exceed interest in your monthly payment until roughly year 19. Lucas is 32 years old right now. He will be 51 before the math flips in his favor. In between, he will have sent the bank about $392,000 in interest. He borrowed $320,000. He will pay the bank almost $713,000 total. Congratulations, Lucas, you bought one house and paid for 2. And this is the best case version of the math. This is if nothing else happens. No insurance shocks, no special assessments, no roof, no HVAC, no nothing. In real life, the house doesn't care about Lucas's spreadsheet. It has opinions, and those opinions are expensive. Let's talk about what actually eats you alive once you own. Homeowners insurance in America has risen 46% since 2021. That's 3 times the rate of inflation. The average premium now sits around $3,000 a year, and that's if you live in a state where the house isn't actively trying to get reclaimed by the ocean. If you live in Florida, the average premium is approaching $8,300. Lucas's cousin Chris bought a place in Tampa in 2022. He just opened his renewal notice and it's $8,300, up from $4,200 3 years ago. He stared at the number for a full minute before he opened his banking app and started crying, which is actually a reasonable response to a 97% insurance increase. California's doing its own thing. State Farm stopped writing new policies there in 2023. Then they non-renewed 30,000 homeowners in 2024. Then, after the LA wildfires caused $20 billion in industry losses, the state approved a 17% emergency rate hike. California is now the only place in America where the insurance company non-renewed me and my house caught fire are basically the same sentence with extra steps. Insurance now makes up 9% of a typical monthly mortgage payment. Highest share on record, and no, you can't just skip it. Your mortgage lender would like a word. Maintenance is running its own parallel inflation economy. The rule of thumb used to be 1% of the home's value per year. In 2020, that was $6,200 on average. Today, $8,808. That's a 42% jump in 5 years. Labor's up, materials are up, and that one guy who still knows how to fix gas furnaces now charges like he went to Harvard Law and wants you to know about it. A new HVAC runs $5,000 to $15,000. A new roof easily hits $13,000 foundation work, $2,000 to $8,000. And the most honest survey number from the last 2 years is this. 42% of homeowners now say maintenance and hidden costs are their number one regret. Not the price, not the rate, the slow grinding tax of everything that breaks in a house that, it turns out, has been quietly falling apart since the inspector handed you a clean report and a fist bump. Then there's the property tax ambush. In Texas and Florida, the second you close, the county reassesses the property at market value. The previous owner's tax protections evaporate the same day you get the keys. Your bill can double overnight. Cotality reported that escrow payments rose 45% between 2019 and 2025. In Colorado, homeowner escrows jumped 77%. You didn't get a raise, your house did. And if you bought a condo in Florida, I have some bad news and then some worse news. After the Surfside collapse, the state passed laws forcing condo associations to maintain real structural reserves. Starting January 2026, they can't waive them anymore. Picture this. You're an imaginary friend of a friend in Aventura. You closed on a condo in December for $380,000. You felt smart. In February, a certified letter arrives. Your building needs $40 million in structural repairs. Your share? $180,000. Due in 90 days, you try to refinance. The bank laughs politely because your condo's now worth less than you paid for it and no comparable units have sold in 6 weeks. You try to sell. Nobody will touch the building. You are, for all practical purposes, on the hook for $180,000 in cash on a condo you were planning to flip in 3 years. This isn't hypothetical. Real Aventura buildings have hit owners with assessments up to $400,000 per unit. Florida condo prices are down 9.9% year over year, the steepest drop since 2009. There's a reason. Okay, Lucas and Michelle are still at the kitchen table. The calculator has been replaced by a second glass of wine. Here's what they're starting to realize. Every single force in this market is moving against their future net worth. Prices are at all-time high ratios to income. Rates are average by historical standards and feel insulting only because we were briefly spoiled by pandemic 3% mortgages that are not coming back. Insurance is compounding. Maintenance is compounding. Yet taxes are compounding. Commissions didn't fall after the NAR settlement. They actually went up slightly in 2025, and the investment they'd be making is for the first time in a decade, losing to inflation in real terms. Which brings up the question, the real estate industry really doesn't want Michelle to sit with. What happens if they just don't? Run the numbers on renting the same house. In all 50 of the largest US metros, mortgaging costs 38% more than renting on average. Bankrate ran the numbers in 2025. The average mortgage payment was $2,768. The average rent for a comparable home was $2,000. The gap widened in 38 of those 50 metros. In San Francisco, owning costs 190% more than renting. In San Jose, 186%. Austin, 88%. LA, 89%. Not a typo, nearly double. Now, take the difference and put it somewhere useful. Lucas and Michelle have $80,000 earmarked for a down payment. What if they rented instead, dropped that $80,000 into a low-cost S&P 500 index fund, and then invested the $500 to $800 a month they'd save versus owning? At a conservative 7% real return, real after inflation, below historical average, after 10 years, they're sitting on about $244,000. After 20, $570,000. After 30, $1.22 million in today's dollars. That's what the housing industry is actually comparing itself against when they tell you buying builds wealth. Now, run their house scenario. They paid $400,000 over 30 years with down payment, interest, taxes, insurance, maintenance, HOA, and closing costs. They'd put in roughly $1.21 million. If the home appreciates 3% a year, which is actually above the long-run real return on U.S. housing, it grows to about $970,000. After they pay 9% to sell in commissions and closing costs, they net around $885,000. So the house costs them about $325,000 net to own, plus the massive opportunity cost of what that down payment and monthly differential could have compounded into. In most scenarios, the renter with index funds ends up wealthier, often dramatically so. Now, I know exactly what's in the comments right now. But Nick, my parents bought a house and tripled their money. Yes, they did. And here's why that tells you less than you think. Robert Shiller, the guy who won a Nobel Prize specifically for studying long-term housing prices, has data going back 130 years. Real US home prices, inflation adjusted, were essentially flat from 1890 to 1997. Your great-great-grandfather's house was also not a good investment. He just didn't have a calculator to find out. Then, in the last 25 years, prices went vertical. Shiller's take, and I'll paraphrase rather than quote him directly because I value my job, is basically that housing wasn't historically seen as a wealth-building asset. It depreciates, it requires maintenance, it goes out of style. The idea that it's some kind of money printing machine, that was a fad. A 25-year anomaly that people mistook for a law of physics. The S&P 500 over the same century-plus window has returned about 6.5 to 7% per year in real terms. That 6 percentage point gap between stocks and housing, compounded over 50 years, turns into roughly 10 times the real wealth. Not 10% more. 10 times. That's the difference between retiring at 55 and retiring at 73. Okay. If the math is this lopsided, the obvious next question is, why is everyone still trying to buy? Why is this still framed as the American dream? And the answer is not what you think. There is a massive, well-funded, extremely sophisticated machine making sure it stays framed that way. The National Association of Realtors spent $86.3 million on lobbying in 2024 alone. They were the single largest organizational lobbyist in the entire country. $86 million a year to convince you that a 30-year debt instrument with a 9% exit fee is spiritually equivalent to freedom. They spent another $66 million on marketing and PR. That word realtor, capital R, that you hear on every commercial and yard sign, it's a trademarked brand that costs over $150 million a year to maintain. The American dream you were handed was not an organic cultural inheritance. It was designed, funded, and distributed by a trade association whose entire existence depends on you buying a house every 7 to 10 years. And let's kill the most durable slogan of all, real quick. You're throwing money away on rent. On Lucas and Michelle's $400,000 house at 6.3%, year one interest is about $20,000. Property tax, $4,400. Insurance, $2,400. Maintenance, conservatively $4,000. HOA, $3,300. That's more than $34,000 a year they'll never see again. Not building equity, not going into the house. Just the annual cost of owning a thing, the bank, the government, and the insurance company all have first claim on before they do. If they rented a comparable home for $2,000 a month, they'd spend $24,000 a year. They'd throw away $10,000 less than if they owned. And they'd keep the liquidity, the mobility, and the ability to actually invest the difference. If that's throwing money away, what exactly do you call the $34,000 they just handed the bank's interest column? A donation? And the tax benefit, the one thing that used to genuinely tilt the math toward buying, mostly gone. Y'all, before 2018, about a third of taxpayers itemized and got a real benefit from the mortgage interest deduction. After the tax changes that were just made permanent, only about 10% of taxpayers itemize. Mortgage interest deduction claims are down 59% in dollars. 60% of the remaining benefit flows to households earning over $200,000. NAR's own website quietly admits that, for the majority of homeowners, the tax code no longer encourages you to own over rent. That's the realtors on their own site, and the advice still persists. Now, here's the uncomfortable part, and I need you to stay with me for a second. If you're 30 years old and you can't afford a house right now, that might be the luckiest thing that's happened to you this decade, because the people who can afford them right now at these prices with these rates in these insurance markets, they're the ones about to find out what a 46% increase in premiums actually does to a household budget. They're the ones whose HVAC systems are aging in sync with their property tax reassessments. They're the ones who'll be watching their homes lose real value while their maintenance bills compound. Not being able to buy isn't failure. In this market, it might be the first piece of genuine financial luck you've had. But look, I'm not going to leave you without the honest carve out. There are scenarios where buying in 2026 actually still makes sense. Let me give them to you straight so you can run your own situation. Rule 1, the price to rent ratio in your market has to be under 15. Not 30, not 40, under 15. That rules out basically every major coastal metro and most Sunbelt hotspots. It rules in places like Detroit, Cleveland, Pittsburgh, parts of Chicago, New Orleans, and a handful of Midwestern cities where the math actually tilts back toward ownership. Rule 2, you have to be confident you're staying at least 7 years. 10 is safer. With 8 to 10% transaction costs to sell, anything shorter gets eaten alive by closing costs before appreciation has a chance to do anything. Rule 3. You put real 20% down without draining your emergency fund or pausing your retirement contributions. If buying forces you to zero out liquid savings, you're not ready to buy. You're ready to be financially fragile in a more expensive way. Rule 4. Total housing cost, all in, stays under 28% of gross income, not 40. Not 35, 28. That rule existed for a reason. Rule 5, the house represents less than 30% of your total net worth at purchase. If it's more, you are not diversified. You are concentrated. You just happen to be concentrated in a thing you can also sleep inside. Hit all 5, buying still works. Not as a wealth building machine, as a reasonable lifestyle decision with some hedging properties. Morgan Housel describes the primary home, and I'm paraphrasing, as essentially a large liability wearing the costume of a safe asset. Buy it for family stability, buy it for the neighborhood, buy it because you want to paint the walls whatever color you want. Don't buy it because a realtor told you it's the best investment you'll ever make. Because across the long sweep of history, it almost certainly isn't. And here's the thing that gets lost in all of this. Nobody's saying owning a home is bad. Nobody's saying rent a 1 bedroom forever out of spite. What we're saying is that the decision should be made on actual numbers instead of cultural momentum. You are not failing if you don't own a house at 30. You are not failing if you don't own one at 40. The median age of a first-time home buyer in America is now 40. The first-time buyer share of the market just hit a record low of 21%, the lowest since they started tracking it in 1981. You are not behind. You are part of a generation responding rationally to a broken market. What you're being told is that your instinct is wrong, that you should stretch, that you should figure it out, that you should get in before it gets worse. But every one of those statements assumes we're in a normal market. We aren't. This is a market where 80% of existing homeowners have mortgages below 6% and won't sell at any price, which artificially constrains inventory, which props up prices against a backdrop of collapsing affordability. It's a market where insurance companies are quietly pulling out of entire states because the risk math stopped working. It's a market where 74.9% of American households cannot afford a median price new home. That's not a healthy market. That's a bubble slowly, quietly, unevenly deflating, and the deflation is going to happen on the backs of whoever bought last. Back at the kitchen table, Lucas and Michelle have closed the laptop. The pre-approval letter is still sitting on that stack of unopened mail. They haven't decided anything yet, officially, but they're looking at the $80,000 in their savings account differently now. It's not a down payment anymore. It's a decision. It's optionality. It's the ability to move for a better job, to ride out a recession, to not be one HVAC replacement away from a credit card spiral. It might end up buying a house eventually. It might end up buying a decade of compounding instead. But right now, at 11:47 p.m. on a Tuesday in 2026, it's the most valuable thing either of them owns, and it stays that way only if they don't give it to a bank in exchange for the privilege of paying $713,000 for a $320,000 loan. If the math doesn't work in your market, in your situation, on your income, don't buy. It's not a moral failing, it's arithmetic. The trap isn't renting. The trap is signing a 30-year commitment to a financial structure designed in an era when houses cost 3 times your income, not 6, and then telling yourself it's the same deal your parents got. It isn't. The math has fundamentally changed, and pretending otherwise is how you become somebody else's cautionary tale at a dinner party 5 years from now. Rent, if the math says rent. Invest the difference aggressively. Buy if and when the math actually says buy. In a market where the math is capable of saying that, run your own numbers, factor in every cost, and ignore every voice in the transaction who profits from your signature. Because the only person in that entire equation whose long-term interests are genuinely aligned with yours is the one watching this video right now. If this helped you see your situation more clearly, hit the like button and subscribe. Drop a comment with your city's price to rent ratio because I actually read them. And frankly, some of them are going to be horrifying. I'll see you in the next one.